Thank you so much for coming to today's Tax Policy Colloquium. I'm Leandra Lederman. I'm the William W. Oliver Professor of Tax Law at Indiana University Maurer School of Law. And we're really pleased to have today two professors presenting their co-authored piece, Admin Law and the Crisis of Tax Administration. So we've got Professor Stephen Shay and Professor Brian Galle. And so let me go ahead and give you their brief bios. So Steve Shay is the Paulus Endowment Senior Tax Fellow at Boston College Law School. He was Deputy Assistant Secretary for International Tax Affairs in the U.S. Department of the Treasury from 2009 to 2011, and in private practice as a tax partner with Ropes and Gray for many years. And he's been a professor of practice at Harvard Law School, a lecturer at Yale, University of Oxford, and the Leiden International Tax Institute. And he consults for international organizations and private parties and has testified as an expert before judicial and arbitral tribunals on behalf of governments and private parties. So that's Steve Shay. Brian Galle is a professor of law at Georgetown University Law Center. He's taught at many other law schools, including Boston College Law School and Florida State. He was also a visiting professor at George Washington University Law School and a visiting fellow at the Urban Brookings Tax Center. Before teaching, he was an attorney at the Criminal Appeals and Tax Enforcement Policy section of the U.S. Department of Justice Tax Division. I could go on much longer with respect to both of them, but in the interest of time, we're going to just jump right in. And Professor Shay is going to be the primary presenter today, as I understand it. And Professor Galle may jump in with some comments, and they'll both be available for questions. So right now, let me just give Professor Galle a brief chance to greet everybody, and then we'll turn to the presentation with Professor Shay taking the lead.
Thank you, Leandra, and thanks to everyone for joining us this morning. I'm very sad not to be in Bloomington and missing a chance to have a nice morning bike ride there.
Thanks, Brian. All right, Steve, you want to take it away?
Thank you, Leandra. Brian and I are very happy to be able to share what is a very early paper, as you have seen, if you've had the chance to read it. And I know the students have, and Professor Lederman's going to send me the response papers after this, so I haven't seen them yet, but I really am looking forward to them and to thoughts and ideas, and as well as from all of you. So I'm going to take 15, 20 minutes, do a very high level review of sort of a set of issues in the paper, and then we can open up for questions and comments, which is what Brian and I are both very keen to receive, starting with the students and then from the rest of you. Just a note, this is my first opportunity to collaborate with Brian, and he is opening up vistas for me, because this is not my, what you might think of as my primary wheelhouse or my wheelhouse at all. But it does intersect with issues that I have been quite concerned about from the perspective I have had on the U.S. federal income tax system, and that is how these rules of process affect the substance of what the IRS is able to do. So if Brian were doing this initial presentation, he might have a slightly different emphasis on different things, but that's the fun of collaboration. And I'm gonna make sure Brian stays on mute. I hope he's had as much fun with it as I have. So let me share a screen. I'm not gonna give him a chance to comment. Let me share a screen and put up some slides. So what are we going to do? We're going to cover a couple of issues that we touch on unaccountability of the IRS, which is basically standing, over accountability, which is too much review of the IRS, and how that combined with some other issues sort of hits the IRS from both sides, and to some extent, or to a considerable extent, we argue, discourages action. And my take and my concern in 40 years is the effect on the IRS's ability to raise revenue. The paper provides equal weighting to limitations on its ability to act as a regulator. So the IRS does have three functions. It raises revenue. And since I've been practicing as long as I have, which is about almost 40 years, that's, maybe it's more, I should be careful, that when I was starting was what the tax system was about. And it's taking on more and more other functions, and are part of the way the tax system regulates is by giving breaks from taxes, which exploded in the 1990s because essentially the two parties that govern our country couldn't agree to raise the revenue, or couldn't agree actually to spend money. And so the resolution of that was to in tax expenditures, to give away money indirectly by giving breaks from taxes. And that's another form of regulation, but it's also was a substitute for expenditure side of the budget. And that function has become very large. And one of the comments on the paper is that we should probably break those out more clearly. Then we get to proposals, and this is really, in a sense, what the most fun part of the paper is, to think about what are some things that can be done. And there we talk about a way to review things that currently are unreviewable. So get one step more specific, but not a whole lot. So one set of issues we see are basically the limitations on the ability of the public to question what the IRS does in certain circumstances. A, when they are not the taxpayer. B, when the IRS gives away revenue rather than raises revenue, because our standing doctrines make it difficult to challenge. And if you're the taxpayer, you don't really care to challenge that. And so that has some pretty clear effects. We don't go into this in great detail in the paper, and I think we're still, speaking for myself, I'm still thinking about how to work it out. But the fact is, the flip side of non-disclosure of taxpayer information is how much it binds the ability to put information in the public domain that allows the public to really assess what the IRS is doing. And so that's many people, and myself included, favor taxpayer privacy. Although a little off topic, I don't favor it for corporations in very large degree, but that's another paper, another topic. But it does have this other effect, and so it contributes to the inability of the public to review what the IRS is doing. Next topic, somebody's told us we should break these two topics apart. We presented this paper last week actually, and received this as a topic. And so far, that's a question we'll have for all of you. But the next topic is really relating to the bringing in fuller force of the Administrative Procedure Act to bear on the review of tax regulations, tax actions, and that's become like a hydra head. And so I think one of the things we want to do in a next draft is break that apart a little more clearly. So it's not about Mayo Foundation. All Mayo did was say the same rules are going to apply. It's more about how those rules apply to tax. And in particular, how to apply what's called hard look review. And here, as somebody who hasn't been as much exposed to administrative law as many of the professors on this Zoom, I still have trouble understanding, I'll draw on the Altera experience and including cost sharing, stock option costs, compensation costs into a cost sharing pool of costs. That was first asserted by the IRS in the mid-1990s, and it was finally locked down in 2020 when after two successive series of efforts to put it in regulations overturned, and then regulations done finally in a way that seemed to be acceptable to everybody, all basically saying the same thing. From the first assertion of an interpretation to a temporary regulation that was overturned to a set of regulations that have finally been upheld. When that process delay to somebody who's not an ad law junkie strikes one as potentially somewhat inefficient. That's a mild statement. And particularly when cert was denied, or it was either at the Ninth Circuit decision or when cert was denied, a number of major multinationals adjusted their financial statements because their accountant said, well, you really have to now acknowledge that you've got to take into account these stock option costs. And take one of the largest, probably the largest one, Alphabet, also known as Google, the adjustment to its financial statement was $4 billion. And they only had to adjust financial statements for open years. So a lot of years from 1995 were closed. So $4 billion doesn't capture the revenue loss from that series of delays. So that catches my attention. And why does it catch my attention? I was not my bio that we've talked about. I was in the government from 1982 to 1987. So I've actually had 2 tours of duty. And I look back many decades later to realize I had 3 revenue raising bills during my time in government. 82, 3 or 4, and 86 was neutral. But but we collected revenue. The next revenue raising bill was 1993. Then I think it was 2013, and we're about potentially to have one in light of the Biden proposals. The fact is, it is very easy to give away revenue. It is very, very hard to raise revenue. So my practical political understanding is retaining your tax base is really important. So that motivates a lot of my interest in this subject. And APA review is important to achieve certain goals, to achieve public, making the government say what it's doing and justifying what it's doing. But there is this tension when it gets in the way of being able to effectively and efficiently raise revenue. Whoops, skip it, there we go. So the argument we make is that really from several sides, the IRS is discouraged from taking steps that either protect the revenue base or that, and they're in a sense encouraged to be cautious, encouraged not to rock the boat, encouraged to towards what we are calling in the paper inaction. An argument we make in the paper that I'm quite comfortable with, that I think we will probably develop some more, is the fact this ends up hurting disadvantaged populations more than the well-advised and the well-resourced. And we use a number of examples. I could just draw back to Altera. That essentially 20+ year deferral was handled by really good lawyers and really smart lawyering. And just to pick another example, we have other examples of criminal prosecutions that through really superb lawyering have settled out at very, very minimal, no jail time, no indictment. Deferred prosecution arrangements. You can go to UBS. You can look at a number of examples. So those aren't the poor folks. And that's the bias that this has, and that's an important motivation for the way we think about it. So I've actually touched on how the process items that we've just touched on, each one of them is an ocean in itself, I think. How they basically have an anti-revenue or anti-fisc tilt. We have the example of carrying interest. A self-inflicted wound that was much bigger going back to the 90s, early 90s and further in some respects, but we dig it from there with a revenue procedure. That was never really fixed. Now it has been adjusted in legislation in 2017, but still not fixed. And it's a source of ongoing question. Why hasn't the IRS done something in that area? I've already talked about Altera. Xilinx is just the predecessor case. We use two examples in the paper so far. We're going to put in more, I think. But one is a very obscure, but in international tax terms, important regulation under the US GILTI rules that provides an election that achieves a very favorable taxpayer result. And so in saying that, there are two things that should be noted. One is the outcome is favorable to taxpayers, so it's a little hard to see who would challenge it. The second is it is made by election. That is another small hobby horse of mine, because I don't believe in most elections in the tax law because they provide taxpayer choice, and the taxpayer will almost always choose the outcome that has the lowest revenue. So an election is revenue losing by definition. In fairness to the IRS, they really tightened the election between the proposed rules and put in a bunch of consistency provisions in the final rules, but it's still an election. They have made it all or nothing for all the units or not. And that's an example of, okay, there was some tightening, but it's still, it's very hard to justify that regulation, in my view, under the statute, and it's quite pro-taxpayer. The other side of that is, Brian, did you want to say something?
I was just going to say, Steve, do you also want to mention that GILTI might potentially be an example of our end run around budget neutral legislation, in the sense that it might be a source of double dipping, where it seems likely that Congress is going to get some pay for credit for undoing the GILTI regulation when they previously got pay for credit for enacting GILTI in the first place?
That is a great point. And so the idea is Congress can pass something in legislation, and then in regulations, it can essentially be made more pro-taxpayer. So the revenue that was booked for the legislation ends up not being collected. And GILTI, the high tax exception, is a good example. There are several others. The other sort of counterpoint to GILTI is a regulation where the IRS really had to stretch, and some people will feel very strongly and assert very strongly this was beyond stretching. This was changing an effective date of some regulations. The problem was a very pro-taxpayer regulation, an exemption for dividends from control of foreign corporations, was made effective January 1, 2018. But the GILTI rules, which create a minimum tax arrangement on foreign income from controlled foreign corporations, did not become effective until the beginning of your tax year that began on January 1, or if it's a fiscal year after. So calendar year taxpayers, the effective date's aligned. But fiscal year taxpayers, which I might add include Microsoft, Apple, I haven't checked on Alphabet, some big companies, they didn't align. So there was this hole where you could try and take advantage of the exemption for foreign dividends before you had any minimum tax on the earnings. And a number of companies did that and created income generating transactions that would provide a step up in basis, a step up in their depreciable cost for assets during that donut hole, brought it home, and then didn't start guilty until the following year. And the IRS put out a set of regulations that say, wait a second, that couldn't have been intended by Congress. You're not going to get, if you have some kind of extraordinary transaction, so they tried to cabinet around an anti-avoidance objective, then you're only going to get the benefit from that transaction you would have had essentially had guilty been in effect. Taxpayers have screamed, and we'll see the outcome in the courts. So in fairness to the IRS, that was a pro-revenue action, but whether it will be sustained in light of the process requirements is very unclear, and I'm not going to get into more details than that. So proposals, and I am at 20 minutes. The most fun part of the paper for sort of, I don't know, legal academic types, I guess you could put it, I'm not sure, is an idea that would allow the public essentially to raise questions, to challenge, or at least seek review of IRS actions that would lose revenue, for example, or and the notion is embedded in creating a process that does not require Article 3 standing. That is the case and controversy standing that's required to get into an Article 3 court, and instead to create a process where a circumscribed set or by descriptors of actions could be asked for review by taxpayers. The most significant part of the pieces of that we discuss in the paper are, should this extend to review of enforcement actions in relation to individual taxpayers? And we are quite strong in our position, no, it should not go that far. It should review things more like regulations or actions that have a broader impact. And Brian, I don't know if you want to elaborate on how to articulate that.
We could leave that for questions if people want to know the details.
That should teach me. I won't call. Then the other parts, the other suggestions we have, basically you saw, we haven't really laid out in detail. But there, and this is where we're asking for help, but how do we not lose the important parts of APA review, but try and find ways that it is applied more, what we'll argue is appropriately, and that's a word everybody used to say nothing, but to the tax context. And I personally am not we have references to tax exceptionalism. My own view is that's become a slogan. I don't think it's very important. I do think it's very important, though, to recognize some of the difficulties that you have in the tax system that aren't going to be there, or in administering a tax system aren't going to be there, say, in trying to provide boundaries around climate change actions and things of that nature. And so that is important. Why is it important? And I'm going to try and end here. It's important because we raise $4 trillion a year to support public goods. We are going to have to raise more in the future. We've got to empower the IRS to do that. Somebody pointed out that it wasn't until page 14 or 15 or somewhere in our article, that in our current draft, that we weren't really being appreciative of the IRS until that point. And I think both Brian and I want to make very clear, we are huge fans of the IRS. We actually want to allow them to do their job. We think they do really an excellent job where permitted, and I could give you eons of examples where they are a exemplary federal agency. They've had their foot faults, but basically they accomplish what they do quite remarkably. And if you go watch a filing season or a whole lot of other examples, I'm happy to answer that or defend that in the question and answer. But we do need to allow them to do what they do. And this is a comment that's more from my perspective. I've been in practice most of my career. I don't know any large organization, none that are of the size of the federal government, and none that approach that size that have centralized power into fewer and fewer people. And that is what has happened in our federal government. The executive branch power has been sucked into the White House. The legislative power in the House has been sucked into the Speaker's office. In the Senate, it's sucked into the Majority Leader's office. If you don't create a government that can delegate, you cannot run a country of the size and sophistication of the United States. And to me, that's one of my very primary motivators to get into a space that, frankly, I was not very interested in, the process of the administration of the tax law. But I think it's become too important to ignore. And with that, I will stop.